Good day, everyone, and welcome to our January 2018 webinar. This is Bruce Connors from BlueKey Advisors and Envision Asset Management. And today's webinar is titled Crazy Mr. Market. Written below is Charlie Munger, who's the business partner of Warren Buffett at Berkshire Hathaway. His interpretation of Ben Graham's explanation of his, quote, business partner, Mr. Market. And every day, Mr. Market would come into the office, and some days he would be like really depressed, think the world is going to end, and he would want to sell his share of the business at what Graham thought was ridiculously low prices. And sometimes Graham would take advantage of it and buy his share of the business at a low price. And other times, his partner would come into work, Mr. Market would come to work, and want to buy Graham's share of the business at what Graham thought was ridiculously high prices. So on those days, Graham had the option of selling his business at a really high price. So he was sometimes able to take advantage of his business partner, Mr. Market, by his mood swings, by coming in and buying low and selling high. So Mr. Market is always giving you an opportunity to take advantage of his craziness. And I was reminded of that over the last couple of months as we went through a recent period where the market was selling off pretty much every day, and then over the last few weeks has been rallying pretty much every day when really not that much has changed. So today we're going to go over 2018, how the market performed, look at economic indicators, valuation measures, and take a look going forward. Here's the market last year, and really, you see here Trump was elected in November of 2016. That set off a big rally, and really the themes during this rally was Trump concentrated on lower regulation, corporate tax reform, tax cuts. We had a period of synchronized global growth. Here, right around January 26, as we got into 2018, the market began to peak, especially worldwide. And then in 2018, Trump really took a turn and started focusing on tariffs. We basically began a trade war. There was a global slowdown of economic growth. We started to rally again later in the year and then went through a consolidation period and then have the big sell-off. So overall for 2018, the VTI, which is the U.S. total stock market, was down by 5.21%, and you'll see there was a big rally over the last few weeks since then, plus 7%. This chart concentrates more on really the last few months, and you'll see exactly what happened. So here we hit a peak on September 20th. The market here makes a lower low, rallies up to point number 1, that's a lower high, sells off again to a lower low at number 2, rallies back but cannot get through the resistance level of point 1, falls again to 4, and here you see now we're in a range between 1, 2, 3, 4, rallies back up but does not crack number 3 again, sells off to 6. We got a rally for a couple of days, and then finally here at point 8 we break through the support of 246. Then the market begins a big sell-off down to point 9. Since then it had a rally. So this was December 3rd here at point 5. And the market essentially sold off about 15% from December 3rd to December 24th, from 5 to 9, down 15.7%. Since then, it's rallied 13.6%. So we took a look, and this 15% decline was over 14 days. We took a look, how many other times has the market declined by 15% or more over a 14-day period? And that's what this table shows here. And this is since 1970. And you'll see over the course of the next month, in almost every case except for one, the market had a pretty nice rally. So there are still 4 days left until we're officially 21 business days in, which is considered 1 month. We'll see how it ends up. But right now, the market, for the most part, is following this path of having a big rally, a big rapid descent. One thing that was interesting about this market is here you have the January 26th peak, and the blue represents the U.S., the orange represents international stocks. You'll see how they continued pretty much to move hand in hand until we got here, which was about May. And then after that, the U.S. broke off and diverged from international. So you knew that sooner or later, one of these two charts was going to be right. And it turned out that the international markets were correct, and then the U.S. started following in sync with the international markets and has since fallen. Looking back at style boxes for 2018, you'll see everything was in the red. So if you were an owner of U.S. equities, you lost money last year. Sector returns, healthcare was the top performer. Energy lost 20%, and energy has been a loser really the last couple of years. International stocks, international equities, USA was actually the best of the bunch, down 5.2%. Frontier markets were down 18%. Emerging markets and Europe were both down almost 15%. And looking at fixed income, if you were in short treasuries 1 to 3 years, you made about 1.5%. 7 to 10-year treasuries was 1%. The aggregate overall was just about at break even, and most other fixed income categories were in the negative. Let's take a look at some leading economic indicators. And here's the LEI. The blue line represents the leading indicators, and the red line represents the coincident indicators. So you'll see that both have been going up, and this is not indicative of a recession in the near term. However, you'll note that the leading economic indicators are starting to rise just a little bit less than the coincident economic indicators. Now, this is for December. The January reading comes out in a few days, but it's likely that we're going to see that this number comes down a little more than this one. And often when you begin to see that turn, where the LEI turns down and the CEI is continuing going up and the gap begins to close, that might be an indication that there's a recession somewhere down the road. Although for now, it doesn't appear to be in the very short term. One thing that investors are concerned about is the spread between 10-year bonds and short-term bonds. Here we're looking at 3 months T-bills and 10-year bonds. And usually the spread flattens and eventually inverts, which happens when you get to less than zero, less than the red line. So as of about 10 days ago, we were at about 0.25 basis points. So we have not inverted yet, but we're getting close to that. And that's something that economists are closely watching. The New York Fed does a probability of a future recession based on their historical analysis of the difference between the 10-year and the 3 months. And looking forward to December of 2019, they're projecting a 21% chance of a recession in the next 12 months. And since we've been doing these webinars and started charting this particular statistic, you'll see how it's gone up every single quarter. Now we're at 21%. When you look at when it gets over 20%, a lot of times that indicates that there is going to be a recession somewhere down the road. You'll see here all the red arrows. When it broke that 20% barrier, that meant that a recession is sometime in the near future. But there have also been a bunch of false signals, as indicated here with the green arrow. Initial claims for unemployment. The labor market continues to look really solid. So far this continues to drift down. And the most recent reading is 213,000. And you'll see that number is about as low as it gets. It dates back, to the 1970s and indicative of a strong economy. But you'll see how this indicator normally turns up before recessions. Here we're looking at temporary help and again the unemployment level. And again, before recessions, you'll see these indicators begin to turn, as shown here by the red arrow. But so far, these indicators continue to show a positive environment for the U.S. economy. Weekly hours worked also continues to be strong. It's dipped a little bit, but not yet enough to give off a warning. Here's light vehicle sales, and these often also tend to turn down before a recession, but that hasn't happened yet. This is the Purchasing Managers Index. Anything above 50 is considered expansionary, and less than 50 is considered contractionary. We did have a huge fall down to 54.1 from 58 the prior month, and it was north of 60 a little before that. And again, this indicator will be falling before recessions, and that has happened here. But again, there's lots of noise in these signals. Sometimes it falls and then goes back up. But right now, the big drop last month was certainly not a good sign. So we'll keep an eye on that. This is the Atlanta Fed's GDP now. It's measuring what their calculation of what growth should be in the fourth quarter, and they're estimating 2.8%. These are the recent quarters. So 2.8% would be lower than the last few quarters. And the New York Fed, they project Q4 growth at 2.6%. And they have an early look at Q1 2019 at 2.2% for Q1. This is the Global Purchasing Managers Index. And here you see all the different countries broken up by developed markets and emerging markets. And up top is global markets. And you'll see we hit our peak in December of 2017. These were the highest readings for the three different indicators. And at that time, there were only 2 countries less than 50. So remember, less than 50 would be contractionary. Since then, it's been trending down. You'll see how these numbers pretty much have been going down every quarter across the globe. So as we all know, economies around the world are definitely slowing. And now we're up to 6 countries less than 50. This is the OECD, which stands for the Organization for Economic Cooperation and Development. It's comprised of 36 different countries. Here we're looking at the total leading indicators, the US and Europe. Less than 100 is considered below the long-term average, lower than trend. All three are heading down, and all three are less than 100. The black line is the 100 line. One thing markets were worried about was falling crude oil prices. When crude is high and prices fall off, that's generally a good signal for the market, and the market will rally into that. But when crude prices really start falling, when you get to like less than 50, there starts to be a correlation between stock prices, which are represented here by the S&P 500, the orange chart, and by here, this blue line, which is the GSCI crude oil level. And you'll see how stocks started falling right around here when the price of oil started getting much lower. So there tends to be a high correlation. That's what's measured right here. And then when oil prices started rallying, the market rallied also. This is the high yield spread. This is the difference between the interest rate on high yield / junk bonds compared to U.S. Treasuries. And you'll see how it normally goes up before recessions. That actually started to happen when the market was falling off in December. You see how it shot up from here from about 3.5 or so, got to higher than 5. But in the last few weeks, it's fallen back to 4.44%. European banks represent a threat to the system, but that might be underappreciated by the markets. Just a few weeks ago, an Italian bank effectively went bankrupt and is going to have to be rescued by the government, and that just might be the canary in the coal mine for European banks. I'm not saying for sure this is going to happen, but they're not as strong as U.S. banks, and that represents a systematic risk to markets and economies around the world. U.S. budget deficits are way out of control. Nobody wants to deal with it. This is one of those things that is not a problem until it becomes a problem. And then when markets start demanding much higher interest rates from the United States, it's going to be difficult to bail ourselves out of this deficit situation. Interest rate, the market was really worried that the Fed would be aggressive going into 2019, and the Fed has since backed off comments that they are going to just continue to increase. They say now they're going to take a close look at markets and economies around the world and be patient and make prudent decisions. And stocks were worried that markets were worried they would just increase. So as soon as Chairman Powell changed his tone over the last few weeks, that certainly helped stocks rally. Here you see what the Fed is currently projecting for future rate increases, 2.88%, up to the threes, and eventually a terminal rate or a long run rate of 2.75%. The market, though, is not buying it. They're looking maybe for one more increase and then for decreases after that. This is the 10-year Treasury, and you'll see on a historic basis, it's still very low. It's at 2.72%. But it's up from where it was over the last couple of years. And here on this little chart, you'll see how it got as high as 3.2%. And then this is when the market started its sell-off right here at the beginning of October, rallied back, and then really since fell all the way down. And just the last couple of weeks, it started moving up a little bit. This chart shows the total assets of the Federal Reserve. In other words, all the bonds that they own are represented by the blue line, and the orange line is the S&P 500. You'll see how they have pretty much moved together. So as the Fed was undergoing quantitative easing and buying lots and lots of bonds in the market to help support the economy, the orange and the blue lines pretty much went up together. Here, the Fed stopped their program and remained pretty stable, and the market remained stable also. It was right around here in the end of 2016, probably around the election, that they began to diverge and stocks went on their big rally, probably in anticipation of a better economic environment due to Trump's tax reform and tax cuts, deregulation, as we previously spoke about. But since then, as the Fed has begun to unwind its balance sheet, stocks stopped rising, and now the correlation seems to be picking up again. So the Fed plans on selling off a lot of these assets, and they have been, over the future. So this is going to be a headwind for stocks going forward. This is a chart that we keep track of that shows all sell-offs since 2005 greater than 5%, and it's to show that it's not a one-way ride when you own equities. Stocks go up, stocks go down. So in 2018, we had two sell-offs, one at the beginning of the year for 10% and the most recent one for about 20%. So that was probably a little bit worse than what we've seen in recent years, but again, it's just part of the investing landscape. Let's look at some valuation measures, try and figure out are stocks overvalued or undervalued. Perhaps the best argument of why stocks are overvalued is the Shiller PE. This looks at the price earnings ratio, and they're measuring earnings by taking a look back at the last 10 years, inflation adjusted, and we're currently in the 72nd percentile. So based on a historical look, we're definitely overvalued at this time. However, the Shiller PE has been a terrible indicator for short-term market performance, although you can make an argument it has been a better indicator over the long run. There are some arguments on why the Shiller PE is overstated, and Jeremy Siegel from Wharton is a professor who lays out a lot of those arguments. But this is something that investors do look at and indicates why the market is overvalued. Here we're looking at the forward price to earnings ratio of large cap stocks, mid cap, and small cap. And you'll see that we are right in line with what we were back in October. Now, these numbers were actually lower back in December after the sell-off, but due to the rally, we're back to where we were. So we're at 15.1, 14.4, and you'll see these numbers are less than what they were back in most of 2018 and 2017. The 25-year average PE for the S&P is 16.1, so we're less than that. So we're not in a zone of overvaluation looking at forward PEs. And this would especially be true, of course, if earnings come in as expected. If earnings somehow collapse and this number is not valid, then we're not looking at a good number. But for right now, this appears to show the market is fairly valued. And here, this is kind of looking at the same thing. This is a chart that we keep. This column here is the current PE. In other words, we're looking at the price divided by trailing earnings. And of course, the Q4 earnings for 2018 are not in the books yet, but they should come in close to this number. So we're about 16.5 on a trailing basis, which is right in line with the average since 2004. However, one thing that is lower is the 10-year Treasury yield, which is at about 2.75% or so. And that is lower for the most part than what it was up here, and the average is 3%. So again, stocks right now, based on this measure, are about fairly valued. Here's the bond yield of an investment-grade bond divided by the earnings yield. And the earnings yield is simply the inverse of the price-earnings ratio. You take the earnings divided by price. And the point here is the lower the number, that would indicate that stocks are undervalued. Stocks are a better value. So it's actually went negative, and at the end of the year we were at negative 0.4%. Right now we're at negative 0.1%, but you'll see how dating back to 1984, these are ridiculously low levels. So this would show why stocks are a good value. You're getting a good value compared to buying an investment-grade bond. Here's the 10-year Treasury. Now this is subtracting now the dividend yield, not the earnings yield. This is the dividend yield. And you'll see how the difference is about 0.77%. And since the market rallied, that was at year end, since the market rallied, this has gone up to 0.96%. So this kind of tells the opposite story of what the slide earlier did. Here, 10-year Treasuries, while still low historically compared to some larger numbers, they've been going up and up over the last few years. So 10-year Treasuries are now giving competition to equities for some investors. You can get a better yield now with a 10-year Treasury compared to the Dow Jones dividend yield compared to what you could over the last few years. Here's a look at the Morningstar fair value of the median stock that Morningstar rates in its universe, and it's low. It's at 91%. So 100% would be considered fair value. That would be the black line here. You'll see we're all the way down to 91%. This historically indicated that markets are a little bit undervalued and a good entry point. Let's take a look at what might happen going forward, and we emphasize the word might. Back in January of 2017, we posted the front part of this slide, and we explained that equity returns are comprised of three variables: the dividend yield, the growth rate, and the price to earnings ratio. And how these three interact determine what your equity returns are going to be. And the question we posed at the time was, can a stronger growth rate overcome a declining PE? We thought there might be a declining PE because we thought interest rates are likely to rise, and that's exactly what happened. Also, what happened is we did get a much stronger growth rate, and it did overcome a declining PE. So earnings shot up from 118 to 161, And the price earnings ratio did drop from 19 to about 16.5. And the S&P 500 during that time went up from 2238 to 22670. So the answer to this question was yes. Today, we think that since the PE is roughly in line with its long-term average, the question is, can the economy continue to grow and we don't run into a major recession in the near term? Of course, at some future point, there'll be a recession, but that is going to determine what returns will be over the next 1, 2, 3 years. And unfortunately, we don't have the answer to that. We have to just keep an eye on all the economic indicators, although it would appear for sure that the economy is slowing down. Whether that turns into a recession or not, there's a good chance that might happen maybe in a year or so. Here are some sample calculations looking out about 5 years. And we have 3 different scenarios here. This is January of 2019 times 0. That's today. The current dividend yield is 1.83%. We're assuming in all 3 scenarios we get a growth rate of 5% and that the current earnings are about 166.41 for 2019. They're expected to be higher, but we're assuming they'll be cut back as they have been in recent weeks. So we're assuming they decline even more to like 166. I think the current projection is about 171 or 172. So the forward PE is at about 16, and this is the price of the S&P. So going out 5 years, assuming earnings and dividends grow at 5% a year and the PE stays the same, we would get an internal rate of return of about 7.3%. We think that's somewhat reasonable. There are lots of people who think returns are going to be lower than that, but under this scenario, returns would be about 7%. What would happen if the PE increased by 1 standard deviation to 19.3? We consider this an unlikely scenario, but it is possible. And using the same assumptions, you would get a return of 11%. What about if the PE declines to 12.9? That's 1 standard deviation less than the average. And again, assuming that growth increases at 5%. Now, if the PE did decline to 12.9%, that would most likely mean that growth was impacted somewhere along this timeline. But assuming this happens, you would have a return of 3%. Now, let me be clear. These 3 scenarios do not represent the entire spectrum of what might happen. Returns, of course, can be much less than 3%. They can be negative. And returns, of course, could be much greater than 11%. These are just some sample calculations based on some simple assumptions. What happens to the economy overall, which will have a direct impact on earnings, as well as what people are willing to pay for stocks, will ultimately determine what happens to the market. So here are some reasons why the market might go down. The biggest one is the economy. Indicators clearly show that the economy is slowing up. And does it turn into a recession or not? We don't think there'll be a recession in the next 6 months or so, but a year, sometime in 2020, that likelihood is decent at this time. Trade war / tariffs. If this problem is not solved in the next few weeks, if tariffs are ramped up to 25% on China, we think that represents a big threat to economies around the world and to markets, at least in the short run until the problem is solved. Fed interest rate policy. We think the Fed is going to be very patient with increasing rates, and we think they'll watch the economy. But if they become aggressive and just continue to raise rates, that could hurt the market. The unwind of the balance sheet. We explained the correlation between the two, so the Fed hopefully is going to keep an eye on this. The exploding U.S. deficit will be a problem at some point, probably not in the next year or so, but it will be a problem at some point, and it's going to lead to tax hikes down the road. We did not discuss that today, but we believe there are going to be some tax cuts. They're going to have to be somewhere in the next 5 years or so to help with the exploding U.S. deficit. If the European economy continues to decline, that could have an impact on European banks, and there could be a spillover effect around the world. Profit margins have been very high over the last few years, and a lot of that is attributed to the new economy, to the technology companies. They operate on much higher margins. But if profit margins were to revert to their long-term median, that would hit earnings directly, and that would impact your stock market returns. We just talked about tax hikes. Oil prices, they need to stay stable or go up a little bit. You don't want to collapse in oil prices. And then you always have the Trump wild card, You never quite know what's going to happen. The Trump wild card can work for you or against you. Why the market might go up? Well, if the trade wars cease, if we can come to a fair resolution, that would help economies. Assuming there's no near-term recession, prices today appear roughly fair based on the earnings as they're currently coming in and as they're projected. So stocks are not wildly overvalued, except for like the KPE. Most other valuation measures are in a zone of fair valuation. We need to get a turn in the economic indicators. In other words, the economic indicators pretty much month after month have been declining. So at some point that has to stop, which would indicate that the economies are finding some stability around the world, and then we can continue to grow from there. But if they continue to decline, then almost by definition, at some point, there's going to be a recession. And we just spoke about earnings. We need interest rates and inflation to stay under control. And again, the Trump wild card, no major mishaps in Washington. Anyway, thank you for listening today. If you have any questions or comments, please feel free to contact us. We addressed a lot of topics today, and they were all in an abbreviated format. We have bigger opinions on most of them, so if you want to discuss it or have a question about anything, please feel free to contact us. Have a great day, and good luck investing.